In today's video, we're going to talk about The Intelligent Investor by Benjamin Graham. I first heard about this book while I was going through YouTube, and all the finance channels recommended it as far as stocks, but what I found out in the long run is that it's much more about the character of a person than it is about evaluating stocks. But we'll get to that in a moment. First, I want to tell you a little bit about Benjamin Graham. He was an American economist, originally born in the United Kingdom. He graduated from Columbia University and started a partnership of his own. He was the professor that later taught Warren Buffett how to invest. Many people would refer to him later as the father of value investing, and he did have a great career as an investor on Wall Street. With that said, here are a few points that I came away from after reading the book. My first takeaway is that a great investor has the right heart posture. Now, those aren't the words that Benjamin Graham uses in his book, but I'll use them as they're more familiar with my vernacular. What I mean when I say that a great investor has the right heart posture is a great investor doesn't go into investments with the sole purpose of making a bunch of money and becoming wealthy. If that's where you're starting, that's not the right place to start. And that's where I was starting going into this book. When it comes to investing, the purpose of investing isn't to make a bunch of money. The purpose of investing is to keep what you have and to make it grow steadily. Thus, an intelligent investor is not concerned with huge returns, but just that there is a return on investment. An intelligent investor makes specific and very calculated moves in their investment strategy in order to preserve what they already have and to not lose it. Knowing this, my second takeaway from the book is to never buy an investment with debt. This may sound like common sense to some of you, and to other of you, you may have your arguments as far as how leverage could help you better invest. But in this book, The Intelligent Investor, and in a lot of different resources that I've researched, it's best not to use debt to invest. And that applies to buying investment real estate, buying stocks and bonds, buying mutual funds, and real estate investment trusts, and all of those different investment packages. Debt opens up your portfolio to risk, and risk isn't often calculated very well. But more than that, again, back to that first point, the intelligent investor isn't concerned with getting wealthy. The intelligent investor is just concerned with preserving what they have and making it grow. My third takeaway from the book is don't enter risky investments until you have a sufficient safety net, is what they call it. Now, in the opening of the book, the intelligent investor talks about investing in bonds. And in our current market, bonds don't have a large return, but they are pretty stable and pretty secure. As long as we can trust the American government to keep their word as far as paying back debts, the bonds are a really stable investment. Now, being stable, they also don't return a lot. But in the initial steps of being an intelligent investor, you're not concerned with how much it's returning, just that it is making a return and not losing money. Like I said earlier, I came into this thinking that the intelligent investor would teach you how to invest in stocks, and there are some elements of the book that walk you through evaluating a company, but I think it's more about figuring out something more risky as an investment that you can invest in. These more risky investments should actually be postponed until you're in a place where you can handle them. But not only that, the book spends a lot of time specifying how much you should really research the companies or investments you're getting into. Before you put a single dollar into anything, you should have a good track record of what the company has done for the last 10 years. And that goes from everything from financial data to what was happening in corporate governance to what kind of products they're selling. Do you understand the products? You should have a wide breadth of knowledge concerning where the company is going, how it has tracked over the last 10 years, and what you expect it to be over the next 10 years. Is it a fading company? Is it a fading industry where there's not as much interest? Does it have a strong future? Now, obviously, we can't predict what's going to happen next, so you really need to depend on what's happened before. And this is a big undertaking. So the final takeaway is, whatever you decide to invest in, you need to research it a very, very long time. Here on YouTube, I've seen a lot of different YouTubers that have very off-the-cuff moments of what you should or should not invest in. And I think the intelligent investor should take a cautious eye when hearing any of these things and take a more methodical and long-term approach. With that said, the intelligent investor is definitely much more about your emotions towards investing than it is to the brain. And that is the most important concept behind becoming an intelligent investor. With that said, that's the end of the video. If you liked it, please give it a big thumbs up and subscribe down below, and I'll see you in the next video. Totally.